Good morning. Consumer price index numbers came out this morning, and they actually just barely beat expectations. Welcome to Orlando Real Estate Buzz. I'm Brendan Rendo with the Homes in Orlando team, and joined as always by Joseph Dion of Appley Home Loans. Good morning, Joe.
Good morning. I'm kind of a little stoked right now. Like, it's very rarely that I can sit there and say I get a good day on the stock market and a good day in the bond market.
Well, you knew the stock market was going to kind of like the numbers.
Yeah, and you kind of did. And you needed the CPI, you needed those numbers to come in pretty much on expectation for the bond market to react positively.
Mm-hmm. And it was kind of interesting though when we started looking behind the numbers. So let's take a look at those. And the thing right off the top, second paragraph in, the index for shelter was by far the largest contributor to the monthly all items increase, accounting for 90% of the increase. What have we been talking about is those numbers and how we feel that they're overinflated currently. Because rents have slowed down. If you look at realtor.com, Redfin, Zillow, they're all putting out there that rents are decreasing.
Yeah.
Overall, not increasing. And they've still got this number. Here's our shelter number right here. Shelter. They're saying it's still at a 7.7% increase.
Yeah, this is an interesting one, right? Like, I'm not feeling like I feel like what we're seeing on one side doesn't match what we're seeing on this report as much.
Yeah. And it's like, okay, where are they finding their numbers? We know how they do it, which is basically a phone call. And they're not where there's so many sources for getting actual numbers for rental fees that you think would be it match more of what we're seeing out there in the market overall, but we're not.
Yeah.
And then that kind of goes into another item we were talking about today, which was the release of the jobless numbers, because that's supposed to be the saving grace and why the Fed is keeping rates up where they are is because they want a cooling jobs market. And we saw our jobs numbers come out, and we've actually had an increase, 21,000 claims over the past week. So that's a pretty good jump. That's not an insignificant jump at all.
Yeah.
And what they've been saying is the job market's robust. The job market's robust. The job market's robust. But earlier this week, ZipRecruiter, which is everyone knows one of the big spots for posting of jobs and everything like that, they actually revised all their numbers for the end of the year, their outlook. And what they said is the number of job openings and employers' willingness to pay for those job openings has been declining significantly from the peaks of prior years.
Well, that seems interesting.
Where does that tell you our job market's going?
It doesn't seem like it's as robust as it feels, right?
Correct. I mean, we've seen, some bigger companies with layoffs, over the past couple of weeks. So you kind of expected the claims to shoot up a little bit. But that, from 248, roughly 21,000, that's about a 10% increase over the prior week. So I think everything that the Fed has done has really taken effect at this point.
Yeah.
And we've still got some hits to take overall, because you look at the other aspects within the economy, and we know the U.S. got downgraded from AAA to AA plus.
Yep.
But Fitch, right behind that, the day after, came out and downgraded with something which is very concerning to us, is Fannie Mae and Freddie Mac.
Yeah.
Which are the two biggest mortgage originators in the world, actually. and they just got downgraded. Even though you told us that last week they're actually 20% more profitable than they were last year.
Well, isn't that weird how this, like, why are we seeing all of this? It feels like there's more to the puzzle, right? Like,
yeah, and you're just sitting there, and then you know we talk about the banks. The banks are supposed to be solid now. They came in, they did the rescue. They're supposed to be solid now. So now we get this news again contradicting what we're being told. Moody's downgraded 10 regional banks. And what's in all the regional banks are consumer back or commercial mortgages.
Yep.
So as those rates have gone up, their profitability has been shot to heck because they can't generate the interest income off of where the current rates are. Yep. So there's a number of things showing that, hey, our economy is really slowing down at this point. The interest rates hikes that the Fed's done are really taking effect overall. And
we're seeing.
Where's everyone looking for next month? Well, slowly but surely we're getting an increase, and more people, 86.5%, are saying in the September meeting they're going to hold rates.
They're going to hold.
They're hold.
Which I think is what we kind of felt was going to happen, right?
Yep.
Like they're going to hold, and then they're probably going to look to increase a little bit after, potentially.
Yep. Potentially. But I think there's enough news of the economy slowing, and really I think a more, don't want to call it a robust recession, but a higher probability of a harder landing than what they've been telling us, because you've seen in the headlines, a lot of headlines, soft landing, soft landing, soft landing.
Yep.
And this information doesn't feel very soft to me.
Yeah.
Overall, I think, I mean, we've seen it with mortgage application volumes. As our rate goes up, your volume of mortgage applications has dove. We're actually I think it's about 50% less than we were, back in January. So our pool of buyers keeps getting smaller, even though the inventory is staying roughly the same. Our pool of buyers is actually getting smaller. And we're starting to see that with the number of showings that we're getting on houses out there.
Yep.
I've got a couple that, where we may have had 5 or 6 showings in a week normally, we're dropping down to 1 or 2. Comparable wise, we're still good. Comp wise, we match up, but it's starting to get where you really got to look at, okay, yeah, this was 6 months ago. And I'm actually looking up the rates and say, okay, what was the interest rate when this one sold? Was the interest rate at 6%? Well, from 6% to 7%, if I put the numbers in, that now makes this house a $400,000 or $400 more a month payment for the client over where it was back, 6 or 7 months ago when the rates were sitting, 6 and 6.25. And I've got to really go through that with the sellers these days. Like, well, this house just sold back in so-and-so for this much, and I want the same amount. It's like, you're decreasing your pool of buyers tremendously. And it's just something you got to look at. And you're starting to see more and more price decreases in the market than you have seen in, previous years as well.
Yep.
So, I mean, that's where we're going. And I just thought this was kind of interesting. I thought we'd throw in there today. This is credit card debt. We just broke the $1 trillion mark for credit card debt.
Well, we got a spending problem. Like we know that. It
Yeah.
starts from the top, and it
Yeah,
trickles its way
it
down
does.
to
It
everybody
does.
else.
It's some, something, you just look at that and it's like something's going to break like $1 trillion. We have $1 trillion.
$1 trillion. Forget canceling student loan debt. You're going to see people start saying we need to cancel credit card debt.
Yeah. Yeah. I mean, at least the student loan debt is, what, 5-6% interest rates, somewhere in
I
there.
mean, it could be up there. I mean, I think I have one of my wife's student loans is at 9%, and it's a
Oh,
federally subsidized.
there
Like
was,
it's federal. Like they're making their money off of student loans too.
yeah. But I mean, you're talking some of these interest rates are 28, 29%
Yeah. Dude,
interest rates.
there's nothing you can do with that. Like that's horror. Like that's hard. Like
Yep.
people aren't going to be able to pay that off.
Yeah. So I think at some point, you're going to start seeing the bankruptcy filings go up as well.
Well, what I'm curious to see is you've seen talks about including student loan debt into bankruptcy, making it easier for people to include it into bankruptcy. I bet you if you see that happen, bankruptcy filings will be through the roof.
Oh, yeah. Yeah. Because you've never been able to
Yeah, the barrier to get it included
cancel
is
any type
so
of federal debt.
Yeah, so it's been so difficult to include it in the past that I think if they change that, and with payments getting ready to restart, and they change that guideline, I think you see it skyrocket.
Yeah. When do they restart? Is it next month?
I think
September?
it's next month they restart. And like you talk about the like the job market and the growth. Like, what did we see on the initial jobless claims this morning?
248.
248, and that was 21,000 above expectation, right?
Mm-hmm.
But here's not, that was 21,000 more than last whatever. But it overshot the number, right?
Yes.
And what have we seen? The trend has always been for that jobless claim, right? It has always been initial numbers come below expectation, then they revise that number after the fact, after the market adjusts to the worst number.
Correct.
So what do you like? What's concerning to me is if we've seen that trend for the last 6 to 8 months, it's a little scary that they're coming up front saying,
we're over.
We're over. Do they revise it even more? Or is this the true number?
That's a great point. That's a great point, because every number pretty much since January has understated the actual claims.
Yeah.
So that's an interesting point. Does it pop up?
Mm-hmm.
Yeah. I mean, if I'm sitting there at the Fed and I look at all these headlines and look at different numbers, I'm stopping. I'm stopping, and I'm probably doing a quarter point reduction to try and actually soften the landing. Because at this point, we've still got several increases to hit the economy. I don't know if you saw any news about China, what's going on in China, but they've actually have deflation right now. And their biggest developer just defaulted on their set of bonds. And they have 4 times more projects going than the other one. I apologize, don't remember the name that defaulted on their bonds. So it's 650,000 units that they've been paid for but have not built.
Wow. Yeah, that's bad.
That's bad.
That's and like I was looking, like China with like going into deflation, like I was reading their manufacturing is like way down, way down. And their exports and imports, like even their imports are down, which they're not exporting nearly, like it's just a drop off a cliff how much they're exporting, but then their imports aren't making up for anything either. Like it's a It's a very, very interesting, like see kind of what, and the funny part is you see the headlines and it's like China's in deflation for the first time since 2021.
Yep. Which was when?
COVID, right? Right? Vaccines. But yeah, right? Like, wait. But like you look at all of that and it's like, okay, this is like, we're starting to see like, and we've been seeing it, right? The rumblings are everywhere. They're kind of going crazy. We're like, and it's like, well, when is that domino, right? It's like, it's kind of like everything's like wobbling, like the table's not steady. The house of cards is built on a table and you got a bunch of toddlers running around the table. Like, like it's a little scary. Something's going to bump and start and it's going to fall over. It's going to knock over. So what is that going to, like, that's where we're kind of at, is like, and the toddlers are, kind of China, US, right? Like it's all, it's all like, so who's going to see the first? And you're starting to see, it's like, okay, well, China's there and US, maybe we fall behind, maybe we don't, I don't know. Like I'm starting to feel like what we're getting today and in this meeting, like in this week and some of these reports, like we're starting to see some trends that maybe, maybe we've got more to the puzzle piece than that's about to come out. That makes sense. Yeah. Who knows? Yeah. I'm not a conspiracy theorist. I'm not saying anything like, I'm just saying, like, it's just really hard to analyze this stuff because nothing really moves the way that you think it's going to move. I mean, today it kind of did.
Yeah, we're like, getting presented stuff this way. And then when you actually look at the numbers, it's like that's 180 from what you're telling us. And it's just, you want to sit there and go, either we're not being told something or the way they're presenting it is not the correct way to present it. And that's really kind of where it is, because the numbers just aren't supporting what they're saying. And at this point, we continue the trend that we're continuing into next month. I definitely see the Fed halting, and I would recommend to them not to do another quarter point increase at this point.
I just think they will.
Let it. I don't know why.
I think they're gonna do that hold and then increase again. I just think that's what they're gonna do. Like,
and I'm just trying to figure it out. It's like, what are you trying? What have you not accomplished? What you wanted to accomplish? I think we got to watch those jobless, especially the jobless numbers, because that's the one they've been holding up over the past year. If we continue to see those jobless claims continue to increase, that may be, I hate to say it, but that may be the saving grace to stop further increases overall.
Yeah. And so, I mean, the reality is I think that's what, like we've kind of said this before, is, what we've seen from the Fed is that they kind of want to see some people suffer.
Yeah. They're just sweet grandpas, grandmas.
You want to see a few sacrificial lambs.
Yep. Yeah, it's unfortunate.
All right, so tell me, like, taking the macro, the big picture, right, and let's go into the micro.
Let's go into our numbers. Yeah.
Right. What are we looking at?
Well, this I found kind of interesting because sales were, I mean, you want to talk about flat. We had a 481 last week. Interesting though, but that was the end of the month, so we didn't see a spike like we normally see a spike. So they held. It was just a straight line. Inventory went up again, slowly, steady for single families. Condos, you did see the end of month spike, which you normally see. And that inventory is continuing to grow overall. Looking at what we look at every week, which is, that original list, we're seeing that number starting to increase again. We're at 96%. So you're seeing about a 4% cut from the original list price to the final. So they're doing about a 2% price decrease. and then doing an additional 2% on top of that, because we're sitting at 98% for the final list price. Our days on market holding pretty steady at 35. And then here we go. See, our weekly sales are they sat flat for the end of the month. They didn't pop up at all, which you see here, end of July, end of May, end of April. We've gotten spikes previously. And our days on market really kind of flatlining. 35 days on market, past 2 weeks held steady. Days on market.
Yep.
But we are, and I think this truly is an effect of interest rates, is we're slowly but surely seeing that increase in inventory because the number of sales are down. So we're not having the velocity of home sales that we're having in the past. So we're able to replenish the few that are being sold are being able to be replenished by new ones.
Yep.
And then same thing here with condos. We're sitting down at 95%. So that's the highest that's been in a long time. And days on market has increased steadily to 45. Oops. And then you see here's our end of month. Of course, we took a little spike up, which we normally do. Here, you look back at end of June. There's our spike for the end of the month. But this is the big thing. Look at that increase in inventory. We've actually got over 1,500 condo units available on the market right now. And that one of the reasons is the financing on them is, again, become more difficult than it has been in the past for people. So you would expect that inventory to increase because the buyer pool is a little bit smaller because of restraints on some of the lending requirements for condos.
Yeah.
So I mean,
and you look at interest rate market, right? We talk about the impact on primary, but on the investment side, it's like your DSCRs. A lot of those options aren't really like the numbers don't work on the condo marketplace anymore.
Yep.
Right.
Yeah, I think I mentioned last week. I got a new listing, condo listing out towards Kissimmee in the short-term rental area, and they had had an $80,000 increase in their interest, or not in their insurance cost for the year, and that's going to get passed on. And there goes those HOA fees.
Yep, they're going up.
And it's interesting when you look at historically, you look at a listing and you look back 3 years ago and the HOA fees may have been $250 and now they're sitting $450, $500. The HOA fees have almost doubled in the past 2 or 3 years for a lot of these condominiums out there. And if you're looking for an investment, you're now looking, okay, I got to do $500 and you can't control the increases.
Yep.
Because if the insurance continues to increase like it has, you might expect another $20, $30 a month.
Yep.
Increase in your HOA.
Yeah.
So that's one of the things I think it's going to put downward pressure on the prices of the condominiums. I mean, I have a client, she's downsizing. We looked at several over in Champions Gate, and there was one of them had a $740 a month HOA fee. $740. It was a 1,350 square foot, 2-bedroom, 2-bath condominium.
Yeah, it's Champions Gate, but
yeah, I mean, the other ones in there were
providing you for $750.
Yeah.
Like you get cable, internet, a personal butler. Like what? Like, like
dinner delivered, every evening.
Right, like meal delivery plan. All right, personal trainer shows up at your house 3 times a week.
So I mean, how do you sell that? How do you
Yeah, that's intense. That's
Yeah.
hard.
And then the other ones we were looked at, they were still at $500 a month. And you convert that into mortgage amount, and you're like, okay, why am I buying this as opposed to a house?
Yeah. 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 I mean, that's $750. That's a lot.
Yeah. I did a double take, and then actually called and checked. I'm like, is this actually right?
Yeah.
740. And they're like, yeah, we got this one, we got this, we got this. And I'm like, okay.
You got the condo, the master, and the master.
Yeah, literally. And it's like, oh, well, I don't even want to try and keep them straight to begin with,
Yeah.
So it's, I think we're going to see a steady market going forward, but a very, I just don't see the price increases coming. I don't see how we continue the growth that we've had in home values with the mortgage rates staying, roughly above 7 right now.
Yeah, and I don't. There's nothing that's really that's helping. If that makes sense. Like, there's nothing that's kind of like helping push these numbers into a trend that you're like, you feel good about. That's like, okay, they're gonna bounce back down. I don't see it right now. I think maybe we get some relief fourth quarter. I think if the Feds pause in September and then hold and don't increase for the rest of the year, we'll see some relief. But my concern is this: is if the Feds pause in September, right? And we see a little bit of relief, you're going to see home buying numbers go up if rates drop, back into like say 6.875, 6.75, which is going to spur the Feds to increase again. So it's almost like we need the Feds to pause and for everybody to be like, what's going to happen, and nothing change. For at least 2 cycles. And then we start to see some improvement, because we're playing this game of cat and mouse. Is every time rates get too high, everybody holds. And then the Feds go, oh, okay, we did enough. And then the moment it starts to drop, people go, okay, it's time to buy again. And then the Feds go, well, we got to go back up. And we're just playing a game of, we're doing 2 steps up and 1 step down, right? Like on the ladder.
It's like whack-a-mole,
Yeah. So, I think that's where we are. I don't see much more. We're seeing those numbers kind of drop. You're seeing, you are seeing that the applications, they are slowing down, we are noticing it. And it's because, they've been solidly over 7% for the last week, and that's, national daily rate surveys. And, a lot of like what people don't realize is that daily rate survey might be 7.05 average, but there's people quoting points to get to that 7.05 average. Like, it's not like that's par pricing.
Man, I had a meeting with a small builder out of DeLand yesterday, and he's like, what can we do? I said, probably the first thing you want to offer is a buy down. Offer a buy down, and absorb it in your price. Because you can affordability factor is the biggest factor right now for everybody.
Yeah. That's it. I'm having and that's the funny part is I'm having every buyer that I talk to is, what's the payment on this house? Okay, that's too much. Okay, what is it going to take to get to here? And it's like, the funny part is the conversation is not like, oh, like I want to be here and that's firm. It's kind of like, well, I'm renting, my rent was $1,900 last year. It just went up to $2,200. I'm okay if we go to $2,500 to buy, because I'd rather pay that to own than to rent. Is there any way we can get to $2,600? I know the payment's at $2,700 for this house. Like, the buyers are so deflated in a lot of what's going on. Is like they're just talking themselves and they're going, okay, I want to be here and I want to be like, 2 years ago, it'd be like, I'm renting at 2,000. I can buy something nicer for 1,900.
100.
And
Yep.
now it's, my rent went up to 2,200. I'm willing to go to 2,500. And then they're really like, but I'll stretch to 2,600, but I just can't do 2,700. Right.
Mhm.
And that's a
Yep.
conversation I just had with a client this morning before jumping on this one. And it's like, and I feel, cause I'm like, man, like that's a payment. And he's making 75, 80,000 a year. He can afford it. His ratios are in line. But it's still like, if you're only making $8,000, like let's say 80,000, you're making $7,000 a month before taxes. After taxes, you're making 5,600, and you're saying right off the bat that you're willing to go half of that or more. Like, that's a tough place to be. What is the old adage? They say 25% of your income should be your mortgage payment.
Yeah.
Like, that's hard. Like that's hard.
I don't know. All my current prospects, buyers, no one's 25%. It's literally 40, 41, 42.
Yeah.
They may have a car payment, and we've actually had to look at, we've talked to people like, you might want to try and refinance your car payment.
Yeah.
See if you can get it down $200 a month.
Mm-hmm.
And it's like that. Well, what is it? They came out this week and said that the average American cannot afford a $400 emergency right now.
Like,
it's like, was it 65 or 68% of Americans could not afford a $400 emergency right now?
That's scary. And you know why? Because we got $1 trillion of credit card debt.
Yeah.
Like, I mean, what do you? They've already tapped into.
It's not like you're going to go put it on your credit card because you've already got that maxed out.
You already got it maxed. And if you had like the balance, like I've talked to a lot of people, they've seen their balances go down.
Yep.
So it's like, it's not even because the interest rate went up. The credit card company was like, this person doesn't make enough to make the higher interest payment, so we're going to drop their maximum buying power. So they're losing that credit utilization that they had before.
Yep.
When money gets more expensive to borrow, you get a lot less of it to borrow.
Exactly.
And we're seeing it on all fronts, and it's going to have its impact, and it's having its impact. And we've been going for 33 minutes. I don't want to keep going for much longer. So let's wrap this up. I appreciate you, Brendan. Some really, really good stuff. Hopefully no doom and gloom. Like, I feel like today we kind of, it's a little weighty.
It's weighty, but it's the truth. And you got to look at it. Because it all matters when you're making the biggest purchase of your life, which is a house.
Yeah.
You got to look at it. So, listen, everyone, take care. Thanks for joining us. Again, hit like and subscribe, and we'll see you again next Thursday. Take care.
Knock it out, guys.